Was this largely, Mike, what we were expecting?
Yes, the Fed had signaled strongly. Chairman Jay Powell last week said that they would start buying Treasury bills and an announcement would be coming soon. They want to rebuild the balance sheet. They feel that the repo spike at the end of September, middle of September, was a signal that the balance sheet had gotten too small and they needed to bring it up a little bit. They want to work in what they call a regime of ample reserves, having more reserves than the system, the banking system wants, and they got to the point where they didn't have that.
What do we read into with regards to the timing here? I mean, they're saying they're going to keep this going through at least the second quarter of next year.
Well, they basically look like they've come up with a roughly $250 to $300 billion shortfall in where they want to be. So they're going to get to that position. They're trying to spread out the purchases so that they don't have an immediate massive effect on the Treasury bill market. And then when they get to that point, they would stop in terms of trying to expand the balance sheet for now. But this would be only the beginning, because as currency in circulation rises and the economy grows, that happens automatically. That's a liability to the Fed, so they need to add to the asset side. So they will probably be continuing these purchases at varying levels at varying times over the coming years. It's basically what they've done since 1914.
Right.
Mike, talk to me about the monetary policy effect of all of this. I know they don't want to call it QE, but it will have an effect.
Actually, the idea is that it won't have an effect, Guy. They are buying in an amount they hope will keep interest rates level instead of pushing down on them. They're also buying at the short end of the curve. Remember, QE was done at the long end, and Operation Twist was where they sold short and bought long. So their whole idea is that this is neutral for interest rates going forward. It will keep rates steady, but it would also eliminate volatility in the repo market. So in that sense, it does keep interest rates from spiking.
In terms of where we now think the long-term run rate for the U.S. balance sheet is, do we now have a good idea? The Fed was kind of in the dark a little bit. It basically was pushing, downgrading the balance sheet, trying to figure out the point of contact. Now it pretty much knows where that is. Do we have an idea of how big the balance sheet is going to be going forward?
Well, roughly right now, they're at a $1.5 to maybe $1.4 trillion level of reserves. So they're going to add $300 billion to that. They're going to raise it to close to $2 trillion and hope that's enough for a while. The currency in circulation, a little over $2 trillion, and that will continue to rise. So you're looking at a balance sheet of around $4 trillion. They were over that when the process of shrinking the balance sheet began, and they've gone underneath it to about 3.85 now, 3.8. So it won't be a huge move in the context of the balance sheet, but that's about where they figure they'll be for a couple of years.